What is going on, everyone, and welcome back to Stock Market After Hours. My name is Mark Rushin. I'm a CPA here in the state of California. If this is your first time joining one of our live after market hours shows, welcome. We were off last week because I had a 3-day options workshop. That was freaking fantastic, guys. If you weren't part of that workshop, we're going to be doing it again. It was so popular that we're going to be doing it again in July. So make sure that when you see information come out about that, whether it's in your email or you see a link here on our live show, make sure you sign up for that if options is something that you're interested in learning about. We had handouts and homework items and things like that. It was interactive. It was a great time if you were able to join us. Many of you will probably be on this live show here. You can speak about it in the comment section, but it is good to be back with you guys after having that week off. It wasn't really a week off. I was still working as we were doing the workshop, but I want to start this the same way we always start every single live show is let me know where you're tuning in from and what have you been buying. We see the markets right now on we're less than 1%. It's about a 0.5% from all-time highs was where our intraday high was in the S&P 500 here today. So we are right on the cusp of breaking out to a new record high. And, that things were looking dire. People were upset in early April. They were mad at the administration, what was going on in the market, all of the tariff stuff and taxes and things like that. And lo and behold, here we are back on the brink of a new all-time high. But there is still some things to be concerned about that we're going to be talking about in today's session. So let me know where you're tuning in from. What have you been buying in your portfolio? Janet, good to see you. Ron, Oman, how we doing? Abdullah, how are we doing? Drew from Minnesota. Louisiana's in the house. Janet's in Northern Cal. Bought a little VGT AbbVie. I like that. VOO and some SMH. SMH has just been on a tear there. Lucas, new investor from the UK. Thanks for tuning in, Lucas. It's got to be pretty late there. What is it? About 11 p.m. at night? If my math is correct. Finally, I see good news for MU after I was on the red for the longest time. Iris, patience pays off. Shiva, good to see you from Texas. Blue from Florida. Most recent buy was a cash secured put on Apple. Do we follow that options edge plus there, Blue? On that Apple play? I think we're sitting right around, what are we at? 50% profit so far. So we'll probably looking to close that out here very soon. Pam from Seattle. Chicago, Canada, 2 in a row. New York City, Joyce from New York, Frankfurt in the house. Nice, love it. Mexico's in the house, love it. Saskatchewan, we're going global today, folks. I love to see it. Bought a little Google today for Dan. Bob from Virginia, Dallas, Texas. We love Mark. Bought Google. Nice. Kuwait, 1 a.m. Wow. Staying up late for the live show. What's the sudden up move? So we've been talking about it in our Shiva in relation to your question on AMD. We've been talking about it in my Discord community. And if you're not yet part of that, we have a free version where there's a lot of talking on stocks and things that you can go into. But where a lot of my input is on whether you're an Edge Plus subscriber or an Options Edge. That's where you get access to all of my portfolio, what I'm talking about in the market, what am I buying and selling and things like that from stocks and options perspective. But in that Edge Plus chat, I've been talking a lot about the breakout in AMD. And when we see technical breakouts, first and foremost, I was talking a lot about AMD being extremely cheap. It's a stock that I have in my portfolio. Originally got 200 shares. I have 100 right now. Got some called away in a covered call option play that we did, but we're still riding with another 100 shares that continue to climb higher here. So we got through a nice technical breakout, and the kind of the sky's been the limit for the stock of late. Seemingly for me, I believe it could be due in part and ready for a bit of a pullback. So today I sold another covered call on the stock with the big jump that we saw yet again. So we'll see what happens with that trade. I'll either take the income or gladly sell them away and hopefully get back in at a better price in the very near term. Iris tuning in from Toronto. Got the Panhandle, Poland. What time is it in Poland? Midnight. Wow. Love it. Watching from Idaho. What part of Idaho, Curtis? Buying some McDonald's EPD. Sold cash secure puts on Marvell, ARM, ON, and would like to hear your thoughts on MU earnings. So I haven't had a chance to dive deep into the MU earnings. Um, that was a setup that, you know, the stock is up, I want to say over 100% off of the April lows. I mean, you talk about a mammoth move. We were just talking about AMD again. MU, Micron blows it out of the water. I mean, they just had a fan. I couldn't even have thought that move was even possible. Had someone told me that, hey, 2 months, 2.5 months from now, in the mid-April timing, you're going to be up over 100% if you buy here, I would have said, no, you're blowing smoke. That there's no way. And that stock has just been, going bazonk. I don't even know if that's a word, but it's been going crazy there. So I'm excited. I don't like to see stocks going in, up 100% going into earnings, because expectations increase, analyst expectations increase, and you need a blowout report in order for the stock to even go up. And it sounds like, I just saw the headlines. I haven't had a chance to dive into the details yet, but from the headlines, it seems like they blew it out of the water there. Again, not sure what the guidance was moving forward. I know the stock was originally up over 6% out of the gate. It's kind of settled in around 2 to 3% since the report has come out. So we'll see what tomorrow lies ahead. Again, I don't want to put a lot of emphasis on after hours moves, just because the volume is so low. So I want a chance to be able to dive into those as well for myself. So, but Marvell, that's one that we added. If you're an Edge Plus subscriber, that's a stock that I added to recently. It's had a nice move higher. McDonald's is one that I sold near the highs, but we have looked to get back in via a cash secured put, which that one's been quite profitable for our options Edge subscribers that were following along on those ones. So awesome. Well, we got a good show for you guys today. Again, it's great to be back with you guys. So let's start off with our economic update, taking a peek at what's going on in the market. So it's nice to update these figures. 2 weeks ago, a lot has happened in 2 weeks since our last stock market after hours. We had a little, mini battle, we can call it, go on in the Middle East, where the U.S. got involved and stuff. So we'll talk about that. But all of these figures were seemingly red. Every piece of the index, Dow Jones, S&P 500, NASDAQ, we're all really in the red for the most part. So updating these figures, we now have everything, I'm not going to say solidly in the green, but we are green on the year, and we're not going to complain about that. So we got the Dow Jones up about a 1.1%, S&P 500 sitting at a little over 3.5%, and the NASDAQ is at 3.4% on the year. The Russell small caps continue to be a bit of a laggard here. I think we need more clarity on the economy and the strength of the economy, and we need those rates to come down in order for small caps to really. I know there's a lot of analysts and folks that'll come out on, whether it's Bloomberg, whether it's CNBC, and they keep touting small caps. And it's been something that folks have been touting for a few years here, but it really, you can't expect these stocks, these companies to move much until those rates come down. And it doesn't seem like, I know a lot of people keep thinking rates are coming, rate cuts are coming. I still am not in that camp, even though you had some Fed officials kind of saying there's a little bit of light at the end of the tunnel where they potentially could cut come July. I still think it's a fall situation until we see rate cuts coming. So oil, since the 2 weeks ago, since I updated these slides here, I had it at $63. Today it's at 65. If you just looked at those two slides, you'd be like, okay, oil really didn't move all that much. But we were looking at one point in time where oil was actually in the mid $70 range with the Israel-Iran U.S. struggle that went on for a brief moment there. Well, in the past few days alone, yesterday alone, we saw oil tank up to 8% at one point. So we're back at $65 in terms of crude there. And Bitcoin actually dipped below 100,000 there briefly, and now we're back up sitting at 108. So that's where we're at in terms of the market. In terms of valuation, when it comes to the S&P 500, we have seen earnings estimates come down, albeit slightly. So for the past 6 months, call it almost fully 6 months here after next week, we'll be halfway through the year. The full 12 months looking out, EPS estimates for the S&P 500 has been around 270. As you can see on your screen right now, the forward estimate, and it's a 12-month estimate, has now come down to 265. So using that, earnings come down, but the S&P 500 continues to climb higher. What does that do to your multiple? That stretches things. That makes an overvalued market even more overvalued. So now, based on those figures, we are sitting at an S&P 500 with a forward PE multiple of 23 times even. 23x, guys. Extremely high. Something you know, for those of you that mentioned at the start, hey, I'm buying this, I'm buying that, be mindful. It doesn't mean that I talk a lot is, I favor time in the market over trying to time the market, but it does influence how large my buys are. Let's say I had, 10 grand to spend in the next month. I would probably be doing, 1,000 to 2,000 buys here and there. I'm not going to jump into a stock and use 50 or 70% of the amount of money I have to spend over the next month, or maybe it's the next quarter, on just a couple of stocks, diving into it deeply. Because when we see an S&P 500 that does in fact fall off, that's when you find deals. Why? Because there's going to be a lot of retail investors that just see the headline S&P 500 down 1.5%. I better go sell some stocks, go take some profits in some things that I have. And that's when people just hit sell buttons on stocks irrationally. So it's always important. Number one is to understand valuation. Number two, to have a list of watch list stocks so that you've done your due diligence ahead of time. You've analyzed the health of the company. You know what their margins are. You know what free cash flow is. You know where valuation is now, and you know where you want it to be, where you're comfortable is. And that's the things I talk about within my 6-week investing accelerator program. If you have never learned how to properly analyze or value a stock, there's a number of people that are in and watching this live show right now that have taken this course. And every single person that comes out on the back end of those 6 weeks always says one thing. There's other things that they say, but there's one thing in common that they always say: I wish I did this sooner. I have a lot better understanding. No one's going to become an expert in 6 weeks. But if this is something you're looking to take your investing to the next level and really understand truly how to build a portfolio that lasts, how to build a portfolio that matches your risks and goals, how to analyze the health of a company, how to value stocks and understand options, if that's something that you want to do, then sign up for my 6-week program. It's a one-on-one program. You're going to be able to work directly with me. Okay? So there's only a select few of individuals because there's only one of me. I don't pass you on to anyone else like a bunch of other programs do out there. You'll be working directly with me. So be mindful of that. So back to the S&P 500, sitting at a 23 times multiple. The 10-year average is 18 times. Before that, it was closer to 15 times. But what has happened? Well, we've kind of talked ourselves into saying, well, it's a higher multiple now because we invest a lot more heavily in technology stocks. Technology stocks are faster growing. Faster growing companies usually have what? Higher multiples. Okay, so maybe 18 times is valid there. And technology companies, high growth companies, continue to kind of be at the upper echelon, the top, the highest weighting within the S&P 500. Hence why we have a higher multiple now. But how are we going to get ourselves saying we've gone from a 15 average to an 18 average, and now we're sitting at a 23 times multiple? We can't just keep stretching this. Valuation has to make sense. So how does that one metric come down? Well, it's a PE ratio, price to earnings. So either we need because the 265 is kind of set in stone right now, we need the price to come down, which would bring the multiple down. So we would need the S&P 500 to fall. Otherwise, we need the earnings to go up. And what have we seen in the past month? Earnings expectations are actually coming down. So companies are expected to earn less than when we originally came into this year. However, the S&P 500 is on the brink of new record highs. We have to help this make sense. We can't just blindly, you're going to have people that are all over the internet, whether it's YouTube, CNBC, Yahoo Finance, that are always talking about buy. You have these perma bears that are out there. And I'm a big believer in continuing to buy long term. But do it for a reason. Understand the why behind it. Don't just jump in to jump in. That's how a lot of new investors do it and seemingly lose money right out of the gate, and then they get disinterested. Oh, this is a scam. I'm not doing this investing stuff. Look, I'm down 5%. And understand how to balance your portfolio based on your risk. The other thing is understand interest rates. The bond market, the treasury market, is so much larger than the stock market. If it's not something you pay attention to, at least at a high level, start adding it to your repertoire because it is so massive. Let interest rates, Let treasuries and bonds kind of guide where things are going to, because that's where much more money is invested. We have seen interest rates seemingly start to come down just in the past 2 weeks. You could see, even though it says LW, that was last week, I'm just updating it from the last time that we met. We had a 10-year at 4.54. Today it's at 4.29. We had a 2-year that was over 4% at 4.06. It's now down to 3.8. So we have interest rates coming down, which is a little bit of a pressure release valve, which has kind of helped gain a little bit of steam for the stock market in general overall. So taking a look at those and continuing on with our valuation, let me blow this up so you guys can see it a little bit better there, is you can kind of see where over the past, since 2015-ish, 10 years now, where the forward PE multiple has been for the S&P 500. Right now, we firmly sit at 23 times. As you can see on your screen there, it's that purple one. So 23.02 is kind of our moving average, which happens to be where we're sitting right now using the 265 number. But we need to be mindful of that. There's not too many other times where we get, that much higher. You want to take out the pandemic, that just was a one-off type of thing. So take that kind of out of the equation there. And, we could be, it's not out of the ordinary. And I don't think it would be crazy by any means to expect a bit of a pullback coming out of the markets right now. Things are looking decent, but when you line up and look at the bigger picture and just take a step back, there's a lot more headwinds out there than there are tailwinds. But why do we want to make sure that we don't just try and time the market and sell out of things and things like that? Is because of what we have seen. We have continued to climb, albeit slower. I mean, you could see where we've kind of been consolidating now for a few weeks, but we don't want to try and time the market. So sure, you could take profits here and there, but this is why we want to be diversified, because when certain things are working, that's fantastic. But when they stop working, you don't want your portfolio just to get completely blown up. So there's going to be periods, there's going to be positions in your portfolio that are going to be there as defensive magnets. Okay. Just like a basketball game, you need that defensive stopper. He may not be a big scorer. The scorer are going to be those growth stocks, but he's going to help lock down your portfolio and bring that defense for your portfolio. Things like SCHD, things like healthcare stocks. So we don't need to be overweight those by any means. We want to be right now overweight technology. It's been the best place to be for the past 2.5 years now. And I don't think anything's going to change in the near term. But when we get that pullback, expect those stocks to get hit a little bit there. Google has been lagging. Love the valuation on Google. I mean, it is just, it's comical right now. If Alphabet is not in your portfolio, I don't know what you are waiting for. The PE, I'm being patient. Yeah, right there. Tyler just mentioned the PE ratio is at 17 times. It is half the multiple of Microsoft, but giving you more growth than Microsoft. The margins are better than Microsoft. When you look at driverless technology with Waymo, which again, I continue to talk about on these live shows, I continue to talk about them in the video, with Waymo being so far in advance of Tesla in terms of driverless with these robo-taxis, driverless taxis and things like that, and the comments that I get. I mean, this infatuation with Tesla and Elon and things like that, there's a difference between liking something and facts. I'm always someone that is going to be based on facts, okay? I'm not going to, base my investment decisions because I like an individual person or dislike an individual person. I think that's just as stupid when people just start selling stocks because of political parties. Guys, we're all here to make money, regardless of whether you are a Democrat, a Republican, an independent, whatever there else is out there. And that's why I love my community, the Stock Investors Edge, because we don't talk about politics. We're all trying to do one thing together, and that is to build long-term generational wealth. When I work with individuals within my 6-week investing accelerator program, I tell them right at the beginning, my sole goal is to help you leave a lasting legacy from a financial position, whether that means a kid, whether that means a grandkid, a friend, a family member, whatever it may be. is to set your portfolio up for the long term. It's a program, it's a blueprint that's going to work today, tomorrow, and for years to come. It's not a program where you're going to come in for 6 weeks and I just give you 5 stocks to buy, because another 6 weeks you're going to go by and you're going to say, okay, well, now what do I do? I have more money to invest. Do I just keep invest? No, I'm showing you how to analyze stocks. I have the valuation tool, the metrics that I look at, my valuation checklist, my dividend calculator, homework items for you to kind of learn and do it on your own. This is what builds investors and helps them take you to the next level. A lot of people say, hey, I'm just going to try and do this myself. Sure, it could take you years. You could watch YouTube videos for years and still not truly understand it. You could just follow trade people for years, and it's just going to take a couple of screw ups and bam, your portfolio can get smoked because you didn't understand risk assessment. You didn't understand how to manage your portfolio, diversify properly, and how to analyze the stocks and things like that. So I let everyone choose their path, but those that tend to work with me, I'm happy to say we've never had one person go through the program and say, can I get a refund? I think that speaks for itself from that perspective there. So whenever you guys are ready, you know where to find me. Zombie foreclosures increasing in the South and Midwest. Man, weren't those new home sales data that came out today? That was ugly. And we're going to look at that here in a second. So valuation concerns are obviously a concern. Fear and greed index still firmly in the greed section. I want to say we actually ticked down a little bit since the last time that we met, which is a good thing. I would have expected to see this maybe a little bit closer towards extreme greed, but we're actually closer to neutral. So although this is, a slight concern, I'm not going to get over anxious about it from that perspective right there. It's usually when we're firmly in the extreme greed that I want to say, hey, this might be a great time to start taking some profits. Vice versa, when we're in that extreme fear session, that's when we want to start putting some money to work. So let's take a look at some sector performance here. So we'll dive over into our other screen and take a peek here at sector performance. So I'll share that with you guys now. So here we go. So let's start with the past 12 months. We could see the financial sector kind of pulling away a bit right now, up 25%. Zoom in just a little bit for you guys there. There we go. Followed by utilities, still interesting. Communication services, that's going to be your Metas and Alphabets of the world. Then we have industrials and consumer discretionary. So technology, again, is only up 10%. As well as it's done off of the April lows, it was kind of leading the charge on those April lows, where a lot of these sectors kind of held together quite nicely there. Staples at 9%. So we only have 3 sectors that are actually in the red over the past 12 months. Materials, energy, and healthcare. Year to date, we're almost a year, half the year is almost over here. So 6 months, we have industrials, utilities, and financials. So when I see that, that's kind of interesting to me. I bet there's not a lot of folks that came into this saying, hey, I bet the year to date is going to be technology again, communication services, and industrials again. No, we still see industrials up there, but utilities and financials continue to do quite well. There's communication services. Staples are holding on. And then there's information technology, still up less than 5% on the year, followed by materials and then real estate. Again, the only 3 sectors that are not beating the S&P 500, the only 3 sectors that happen to be in the red: energy, healthcare, and consumer discretionary. So I like to see a lot more sectors above the index as a whole, because that tells me it's a little bit more of a broad rally here. Go back to 23 and 24, we've talked a lot about on this channel. It's been technology, consumer discretionary, communication services. It was really made up of 7 stocks that were pulling together the entire index higher, accounting for something like 60% of the total gains in the index. There's 500 stocks in it, and over 60%, nearly 60%, was made up of 7 stocks, which is why I like to look at RSP and look at how well that is doing overall. And since we're talking about it, let's go take a peek right now to see what the S&P 500 equal weight is. This takes out the market weight, and this looks at every single S&P 500 company as if it had the same weighting within it. So when we look at that, we could see it is up 2%. So 2.1% overall, which compares to the 3.6% that we see from that perspective. Had I seen it in the red, that would give me a lot more concern, but that's not something I expected when you see this many sectors that are above the index. The past 3 months, infotech, consumer discretionary, and communication services have been kind of leading the charge there, whereas energy been very volatile of late, and healthcare are the only ones in the red. And then the past month, infotech, communication services. This right here in the past month, this is really what the past 2 years have looked like, 23 and 24. 2 or 3 sectors above, and that was it. So everyone wanted to talk about how great the economy was, how great the stock market was. Nope, that was just nonsense. Because there was another 493 stocks that weren't doing all that well. Not saying they all didn't do well, but the majority of them actually weren't doing that well. So the past month, it's kind of been a little bit one-sided, but at the same time, everything's in the green. So we like to see that. Consumer staples is barely holding on to the green. So that's where we're at in terms of sector performance. Jump over to the comments, make sure I'm not missing anything. Position sizing is definitely very important for every portfolio. A momentum market in late stage, at least in the near term. I always like to look at things from a long-term perspective, but I think there's a higher likelihood of a bit of a breather over the next few months, to where you could see better entry prices. But this market wants new all-time highs, and I think it's going to take it out before we see that here in the near term. The facts are Tesla robotaxi can't even make a left turn properly. There we go. John, good to see you, my friend. Joyce said, "You are the best. Keep us calm." Totally agree. Always just trying to give you guys the facts. No one-sided, no clickbait material like a lot of folks do in here. It's over. Like, look at these thumbnails. It's a joke that people watch some of these shows and these videos that put that kind of content out. I think it's a disservice, but that's just one person's opinion. All right, let's take a peek at the Fed Watch tool and see where we're at in terms of the good old Fed. So the next meeting for the Fed is going to come at the end of next month. That'll be the end of July. 75% chance right now that we don't see much of a change. I think that's probably more in the camp of, I would say, above 90%, but you can see the other 25% is looking for a 25 basis point cut. However, once we fall into September, things start to change. So right now we're at the 425, 4.25 range. 25 point cut is baked in, is assumed right now. There's at least a 70% chance that we get a 25% cut. There's an additional 21% that we get 50 point cut here. So we could see that roughly 90% is expecting some sort of cut, either 25 or 50 there. So when we look at the probability section, let's zoom that in so we don't have to use our magnifying glasses. So this far right column, that's where we're at right now. So you can see there's no future thought of rates going up right now. The light blue or turquoise, whatever you want to call that, is going to be the highest percentage overall. So we could see 75% believe the rates are going to stay the same there. 68% thinks we're going to get a cut in come September. And then, by October, there's an 80% chance that we'll at least get a 50 basis point cut, whether it was 50 one month, 0 the next, or 25 right there. But then when we look into December, there's a 70% chance. Well, I guess you can even go even more, an 80% chance that we'll get multiple cuts. So right now, when we look at what is the market pricing in, it's pricing in one cut here, maybe 2 cuts come October, and potentially a 3rd cut come December. I'm not in that camp whatsoever. I'm still in the 1 cut camp, but it's all going to be, what is the economy doing? What is the job market doing? And based on everything we know right now, jobs continue to hang tough. Inflation is going to be the big one. As I've told you guys a couple weeks ago and a couple weeks before that, inflation from tariffs has really not been involved all that much yet. We had a little bit in May, but June and July is when you're really going to see a lot of that tariff impact come into play. a lot of the stuff that's been ordered is finally coming in and now being sold, where there's a tariff impact to the earnings. So June and July CPI reports and things like that are going to be very telling. All the inflation reports, to see what kind of impact that they're having there. So we'll have to see if that's what the Fed's really holding on to right now is the thought of inflation, because you don't want to. There's the dual mandate for the Fed is to kind of protect the job market. You don't want to have this interest rate so high that businesses need to start letting people go, so they have to protect the workforce, but at the same time protect against high inflation. But by staying in with the interest rates too high, that lowers spending from businesses, which can lower economic growth and kind of make things stagnant. And the job market can eventually fall off as well. So they don't want to stay in this restricted area for too long, but they are going to bring those down because they need to spur growth. They don't want growth to slow down too much. But the problem is right now, and I know the president wants the Fed to cut right away, is the June and July is what I keep telling you guys. June and July CPI and the other inflation reports are going to be so key. If they come out and we don't see much inflation, then boom, sure, start cutting. I would probably cut immediately when you see that, because you don't want to stay restricted too long to where growth kind of starts to fall off. And then you kind of get into this whirlwind, because if businesses start to see growth slow, then they're going to start to lay off workforce. It's going to be the easiest thing for them to cut, because they can say, hey, let's cut them for 3 to 6 months. We'll hire folks back. You don't want to see that from an economic perspective there. So we'll have to see what the June and July data is. You cut now and inflation comes in a lot higher. You don't want to see it a situation where they have to say, oh, shoot, we're raising them back, because that will just set the markets off. And we would see some major moves to the downside there overall. So, all right. So let me show you guys our next. So let's go to some items in the news here. So obviously we haven't met for 2 weeks, and we had a little battle go on. U.S. I was out golfing on Saturday, and we were sitting around in the men's locker room after at the tables and stuff, and we were just chit-chatting, me and my couple brother-in-laws, and all of a sudden my brother-in-law goes, oh, we bombed Iran. I was out on the golf course. I kind of just threw my phone in the golf cart, didn't check it. It's fantastic. If you ever have those breaks to where you can just break off of technology, which is more difficult for me because I obviously run a full technology social media business with YouTube and Twitter, Instagram, and my full Discord community. I'm always trying to stay connected in some shape or form. But for those 4 hours, just threw the phone in the golf cart. It was fantastic. But obviously I missed some major news stories the whole time. So, that's something that hopefully is behind us. It's anyone's guess from that standpoint there, but hopefully the ceasefire kind of holds in that region. And it obviously sparked oil prices. We saw oil prices jump up to the mid 70s, all of a sudden tank back down to the mid 60s after the ceasefire deal was put in place. Housing, going from a short war over to housing, it's quite the transition, I know. But the housing market continues to be a struggle bus of sorts. And new home sales data came out today, dropped 13.7% in terms of the number of homes sold in May compared to April. That was a massive drop. One of the biggest drops that we've seen in a number of years. Inventory levels are sitting at 9.8 months supply. That is the largest supply. There was a brief stint. It was about a month or two in 2022 when we saw a slightly higher. But prior to that, which, I would throw that into kind of pandemic related type stuff. But prior to that, the supply levels haven't reached this height since 2009. Some food for thought there. 30-year mortgage sits at 7%. So when it comes to investing, especially those of you that are long-term investors like myself, we want to be on the front end of trends. We don't want to be too early, but we also don't want to be too late because we will miss a lot of the gains. This is an area that I'm watching very closely. I've worked, prior to running my whole social media business and my own personal business here with investment coaching, is I worked heavily in the real estate. I'm a CPA, still hold my active CPA, and ran the full accounting department for a housing development company. So well versed in the area. Also talk a lot about REITs on my channel and things like that. That's where a lot of that knowledge and things came from. Was the experience that I garnered from my Big Four accounting background, as well as running the full accounting department for a few different real estate companies. So well versed in the space. And again, I think it's something that's going to turn around. We know that what is on the horizon is if the consumers can stick around, the job market can stick around. It comes down to pricing for folks, affordability right now. You know, the average first time home buyer, the average age was, you know, in the low to mid 30s for quite some time. Now we're looking at it over 40. And a lot of that has to do with affordability. And one of the key affordability components, one of the few negative, there's actually a lot of negatives, is those interest rates. They're hovering right around 7%. That is a massive, massive interest rate payment compared to just a few years ago. I mean, I'm sitting here on my home. I got lucky on my refinance, but I'm sitting at 2.6. There's tons of people that are like me with low interest rates that maybe want to even move, but they can't justify it. Sure, they could sell their house for a little bit more, but the interest going from 2.6 up to 7% is massive. It's hard to justify. And there's a lot of people that are locked in right now. So, you know, there's a couple of stocks that I like in this industry, but I still think it's too early. Late summer, maybe. I'm thinking about something like a DR Horton. I'm thinking more about something like a Home Depot, which has kind of struggled off of its highs. Valuation is okay, so I'd like things to be a little bit cheaper overall, considering what's going on. But if people are going to stay in their homes, maybe they're going to think more about remodels. And we've had some time since the COVID pandemic when the remodeling boom just blew. It just went everyone seemingly. You know, you pass someone walking your dog, and they're like, "Oh yeah, I'm in the middle of a remodel." Everyone was remodeling something, their bathroom, add-on, blah, 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 because we were all stuck in our homes during that time period there. So the remodeling has really slowed down tremendously for the likes of Lowe's and Home Depot. But now it's been a few years, 3 to 5 years. So Home Depot is a good one to look at. Lowe's is a good one to look at. Keep on your watch list. DR Horton, I've actually never owned a home builder, considering I've been in the home building space for as long, just knowing the margins, cyclicality, and things like that. So that's where we're looking right now. Brett said, first live show, as I normally watch your videos the day after. You're my favorite no BS channel that shoots straight facts and doesn't push things just for views. I appreciate that. That is one of our goals. 2 7/8, Dan. Nice. I ain't moving. Interest rates too low for me, for Kevin. Yeah, see, there's a lot of people stuck at 2.25%. Tyler, that is amazing right there. Hoagie says, does anyone have a good site for a calendar of earnings calls? I like to use, let me see if I can find it real fast for you guys. I'm just going to check if you see me looking off to their side here. I actually go to Earnings Whispers on Twitter. So if you go to Earnings Whispers on Twitter, we use this all the time. So they put out all the major earnings that are coming out in terms of that particular week. They update this, every Sunday night or so, or Sunday day. And, you can kind of game plan for the week ahead. Hey, what earnings do I need to be on the look for moving forward? So, and then they give some more detail here, but that's kind of a good follow on Twitter overall. So earnings whisper in terms of it. RK's at 2.2% as well. Wow. Ain't moving. Sheldon's not moving. Drew's at 2.2%. Man, you guys are smoking me. Oh, you guys have the 15-year. There we go. That was smart. All right, let's get back here and keep cruising. So tariffs and trade deadline. This is something that, with all of the Middle East struggle that's been going on, battle war, whatever you want to call it, that a lot of the attention has been taken off of all of this tariff talk, these trade negotiations, these tensions between large countries out there. These still exist, and deadlines are fast approaching. There's still uncertainty out there, and folks need to have this on their radar. Another potential headwind, valuation headwind. We have still geopolitical potential headwinds. We have tariff headwinds, inflation potentially headwinds. I mean, there's a lot more headwinds than if you were to line up some of the tailwinds there. Okay, lower taxes could potentially bring in future growth. From a technical perspective, maybe you can be on that momentum trade type of ideas, but tariffs and trade, I mean, July 9th is what, 2 weeks, 2 weeks away, 2.5 weeks away, something to be mindful of heading into the next couple of weeks with your trading. Still asking yourself, anytime you invest in a particular stock, what are the geopolitical, how much exposure do you have to certain countries? Be mindful of that. And now we get into driverless taxis. And I know there may be some Tesla fans that are out there that don't like my take on Tesla. But again, I try to shoot it straight. And I think Elon is one of the most fantastic innovators of at least my lifetime, I should say, in terms of what he's been able to do. I mean, rockets landing on a floating boat, guys. Driverless technology with Tesla, the underground, all of this stuff. It's just, I think he has more than 24 hours in a day. He has to. But again, take his projections with a grain of salt, because we have seen those that they're usually not even close to what's going to happen. But it was this past weekend in Austin, we finally got the Tesla robotaxis. As one user had mentioned, they were caught driving the wrong way. They were caught braking erratically. They were caught making left turns in the areas that they weren't supposed. Like small. There was no major accidents, at least that I know of. So that was a good sign overall. But it seemed like there's still a few tweaks, and these were cars that didn't just have full autonomy. I mean, there were still folks that were monitoring a lot of this that can, jump in and change the direction of the vehicle if needed, stop the vehicle if needed. So these incidents are under investigation. Meanwhile, Waymo continues to kind of grow, something Tesla is struggling with right now. And not only are they doing well with what they do, but they continue to expand. They are now heading to Atlanta as well, in a partnership with one of my favorite stocks right now, which has been Uber. And a lot of people want to, anytime they hear robotaxi information, they go, oh, time to sell Uber. No, it is not. This is a place where all three of these companies and more can survive. But Uber is the one that has the dashboard and the reach right now. And they're going to be partnering more and more with these driverless type technology pieces. The amount of income, profits that these Teslas and Waymos need to just make a profit is going to take years. Uber doesn't have to go out and buy its fleet. And I know Tesla's going to come out and say, well, everyone can kind of use their car. If my vehicle had driverless technology, no, I'm not offering folks to go out to not know who's getting in my vehicle, what is happening inside of no, I'm not offering that so that I can make a few bucks. So sure, there's millions of Teslas on the road, but what percentage of folks are actually just going to say, oh yeah, I'm just going to rent my car out for a little while. I'll have no idea what's going on inside of it, who's entering it and what's going on, but I'll make some money. Maybe that's just me. Maybe there is a lot of people out there. I don't know. It's just my take overall. But to think that Tesla is close to Waymo, I think is foolish from that perspective. I'm not saying Tesla can't eventually surpass them, but to think they're close, I mean, they had about a 100th amount of the vehicles that Waymo has, a system that continues to work without many of these incidents. Tesla just had, it was like 15 cars out there practically, and they had a bunch of these reports. Even though if you go on YouTube, it's how great the reports are. Guys, who were the people that were driving, that were able to drive into these Tesla robotaxis? It was the Dan Ives of the world. He's never found a day where he doesn't like Tesla. It was all of these Tesla fanboys and influencers and things like that were jumping in the car to do videos on it, how great it is. That's what they do for a living. A lot of them run Tesla YouTube channels. So, again, we want to be mindful of the source, the data, who we're getting it from, and things like that with everything that we do when it comes to investing. All right. That's my take on that right now. So let's end this show with a little would you rather game. And I thought this would be fun, to get some interactiveness going on in the comment section. UFO tours. What software do you use for streaming? I use a software called StreamYard. All right. Here we go. Drew, did you do the 15-year? All right. Would you rather? Investing today. This is investing right now. Investing today. Would you rather invest in Microsoft or Nvidia? For a while, Nvidia actually had a lower forward PE multiple, but given the gains, it's gone from $100 to 140 now, 140 plus. It actually now has a higher forward PE multiple. So right now, and again, you're just seeing one multiple and the next 12 months EPS growth. So you can get Microsoft for 32.5 times practically at 14% growth moving forward. Or you can invest in Nvidia for 34.5 times, but you get next 12 months EPS growth of 42%, but then that drops off to 30%, 25%, and then it drops off to 15%. So you could average those out if you wanted to and be mindful of that. But would you rather invest in Microsoft or Nvidia if you were starting today? Let me know in the comment section. Sydney, Australia is in the house. 8:45 a.m. Love it. Logan's going Nvidia, and Raphael just sold his Nvidia shares probably to Logan. Nvidia for Stuart. Nvidia for Drew. Microsoft for John. Tough question, RK. All right. I would probably go Microsoft for me personally. There's a lot of, where Nvidia, I think Nvidia has got fantastic growth. I'm invested in both of these companies. I have a little bit more in Microsoft, I think, unless Nvidia's, they're very similar to one another. So, but if it were me, I'd definitely do Microsoft. Not selling or buying. Just as At Peace at One said. All right. So would you rather now? Two communication companies here, Alphabet or Meta. Alphabet, you get a 17.4 times multiple, 19% next year, next 12 months EPS growth. Meta, 27.9 times multiple, 7% EPS growth here. Let me know in the comment section, Alphabet or Meta. If you had to buy one today, you had to buy one, let me know. Ronak is going Meta. MC is Alphabet. Dan is Alphabet. Drew is Meta. Last Choi, Alphabet. Ray, Alphabet. Anthony, Alphabet. Lily, Alphabet. Phyllis, Meta. James is going with Alphabet. Raphael, Alphabet. RK, Alphabet. So Alphabet seemingly dominated this one. I don't even think this one's close. I think they're both great companies, but if you're talking right now, I think if you're talking about all of these companies that we've gone through here today in this Would You Rather, including the next one, this is by far the easiest buy right here. I just talked about it in a recent video, and if you haven't checked that out, definitely check it out. Anytime you watch any of our videos, I truly appreciate it, guys. If you just hit that like button, it definitely helps with the algorithm here. We try and put these videos out completely free to drive knowledge and things like that. So a simple like goes a long ways for us, and I really appreciate it. All right, so one more. How about a little growth action here? Tesla versus Palanteer. This is retail investor hood right here. Price to sales, because we're not doing PE ratios because they're just irrationally high. Palanteer has barely made a profit for long enough to even have a 5-year average. They haven't. So we're going to do price to sales multiples here. So price to sales at 17.2, 128 on Palanteer. Revenue is at 10%, and next 12 months revenue growth for Palanteer is at 32%. Let me know in the comment section which it is for you. Palantir or Tesla? I know there's a lot of, when we talk about Tesla fan clubs, Palantir is giving it a run for its money. Tesla, Raphael's not touching it. Both for Julio. Kaysen made a live stream. Good to have you, Kaysen. Palantir, neither. VUG, oh no, too tough. Palantir for Ray. Invested in both for the long term. Nice, Iris. Palantir, already in Palantir. Kevin. Ronix buying Tesla 3 times. Marcus. Tesla. Okay, this one, I guess I'm going to give this one, I'm going to say the crowd who's answered so far, I'm going to say Tesla's probably going to be the winner. I mean, Palantir, sorry, is probably the winner on this one, which is shocking because I'm saying right now, I know there's future growth. It's hard to justify any angle that you look at Palantir right now with but again, that's just me. When you get on some of these growth stocks like this, though, it's sometimes they're just unjustifiable, and you just gotta ride with it. So understanding everything that goes into it. So let me take a moment real quick, tell you guys about 2 options that you have if you want to get more of our content on a daily basis. It's joining one of our subscriptions, either an Edge Plus or Options Edge Plus within our Stock Investors Edge community. With Edge Plus, you get access to my entire portfolio, trade alerts, what I'm buying and selling within the Discord community. We have monthly members only meetings where we dive into my portfolio and go through certain positions, whether I rank them a buy, sell, or hold right now. We have stock deep dives and so much more. But if you're someone that wants to learn more about options or follow my option plays, Options Edge Plus is going to be exact subscription that you want there. You get a weekly report that goes out and dives in, kind of giving you the education behind certain trades that we get into. You get trade alerts on positions that I'm getting into, cash secured puts, credit spreads, buying, calling, all of that stuff when I'm entering, but also when I'm exiting as well, and so much more. There's links to all of that down in the description below. Or if you just want to do the one-on-one coaching, if you're a hands-on and really looking and you want to be driven, because I don't accept everyone into this program here, because again, there's only a select few that I can allow into the program, because again, there's only one of me. So if this is something that you are interested in, we just had 3 students that graduated the program. We only have 3 spots right now. So there's a link down in the description below where you can set up a 15-minute information call. We're going to talk more about these things right here. We're going to show you and build out a customized strategy that's based on your risk profile. That's based on your goals, your end goals, where you want to be in 5, 10, 15, 20 years from now. What should that portfolio look like? How do I analyze stocks? How do I value stocks? And if you want, there's an optional piece that we can bring into the 6-week program, which is all centered around stock options as well. So if you're interested in that, guys, we do have 3 spots that are opening up right now. So you can check out the link, schedule a call. My whole calendar will be open there. You guys can find a slot that works best for you, and we'll go from there. Are there any other questions before we go, guys? It's been good to be back with you. Almost a full hour on today. I know our stock market after hours have kind of been hovering around 30 minutes is kind of what we try to keep them at, but there's a lot of information. I wasn't with you guys last week. We had bombings going on and markets sitting near at all-time highs. So a lot to go on. Just wanted to give you guys all of the information that I have to pass along. As always, it's been great to be with you guys. Can you please share your top holdings to motivate young investors? I share my entire portfolio inside the Edge Plus there. So you can definitely check that one out overall. All right, what else we got? Thanks, Mark. Appreciate you. Thank you guys for tuning in. Mark, with the options subscription, am I going to be able to follow you in real time? Yep. So anytime I enter into a position, it'll be posted on our trade alert. What was the, like it'll say cash secured put, sell to open. What was the expiration date? What was the strike price? What did I fill it at? And things like that. So you can kind of follow along if you choose to follow that particular trade, or you can do little tweaks. In the weekly report that we put out, we'll give you a trade that we're focusing on, but also give you alternative ideas if you want something that's more risky or less risky and things like that. So hope to see you in there. Kevin, thank you. I appreciate that. Long extended afternoon with Mark. What a treat. I appreciate it. Thank you. I appreciate you going over everything. and taking an hour. Cool. Thanks. Signing up tonight. Awesome. We will see you in there. Once you join the Discord, just reach out to me in the Discord community so we can grant you that access. We usually do that once per day for all the new students that signed up on the Discord. So definitely just reach out to me on Discord, and we will go from there and make sure you have the proper access. So awesome. Thank you guys for joining me today. It has been a pleasure being back with you, and hopefully we'll see you next week. Good luck in the market, and take care. Bye-bye.